Let's put housing and construction in firm focus. Actually, an interesting space when it comes to the election. Biz Economics becomes the latest to sound the alarm bells on Australian property, estimating that housing construction will fall 30% in correction, which will last 2 years. Well, for more on all this and how it will impact the economy over the remainder of the year, Roger Montgomery from Montgomery Investment Management joins us now. Pleasure to have you on the show, Roger.
It's always good to be with you.
This is such a hot topic, not only for the election, but for the broader economy, of course. I mean, what are you watching when it comes to housing construction at the moment?
Well, let's take a step back from construction activity at the moment, which is still at an all-time high. But what we know is that what's coming down the pipe is declining building activity. And the reason why is because building activity's leading indicator is dwelling approvals or building approvals. If you end up with a sharp drop in dwelling approvals, and we can see this on the chart that's probably going to be put up now. If you have a look, this is from Macquarie Bank, this particular chart, and UBS, George Theranos at UBS has done some similar work. We've known about this now for a couple of years, that this was coming. And what it shows is in the red there, you can see that there's been a substantial drop in total aggregate dwelling approvals in Australia, from about 280,000 dwellings to about 170,000 dwellings. So you're talking about a 40% drop. Now you can see the black line is still up near the highs, but it's going to come off. Martin mentioned in the introduction, talked about, you referred to margin compression, Martin. You know, that is coming and it's going to get a lot worse. And the reason why it's going to get a lot worse is because in Australia, 9.6% of the workforce is employed in the construction industry. 37% of that is in the residential construction activity. So 3.5% of the workforce is in resi construction, and it's about to halve the level of activity. Now, that means that unemployment, which is currently sitting at, at full employment levels, we could see unemployment rise by 1.75% if we saw that proportion of the working population actually lose their jobs. Now, I don't think they will, but they will earn less. Now, that puts pressure on a whole bunch of things, including retail, puts pressure on credit growth. There won't be any. It's going to be a lot worse in the first few months or the first year of whoever wins the next election. The economy is going to look a lot different to the way it does today. At the moment, we're sort of in a very slow-moving train wreck, but it is going to get a lot worse. And have a look at these numbers on the next chart. On the next chart, what we've got here is effectively a proxy for first home buyers. This is new houses, so these are project homes. And what you can see was we've gone from about 16,000 units a month or 16,000 dwellings a month being built way back in, 2004 or thereabouts, a little bit before 2004. And now we've dropped to about 4,500. So we've seen a substantial drop in building activity. And during the half-year results, we saw companies like AV Jennings, for example, come out and report sharp drops in volume and sharp drops in profits.
How are you expecting all this to be impacted by the election if we get a
Not at all.
If we get a change of government?
Makes no difference.
So negative gearing, capital gains tax, no difference whatsoever?
Well, not to this. It'll make a difference to the appetite for buying down the track, but it's not going to change what's in train now. So if Labor gets in, I think property prices are going to decline further than they would if the Libs actually win. So if you own a home or have a mortgage, you probably know which way to vote. But that aside, this doesn't change because of an election. Remember, we've had elections every 3 years, and you can see this trend particularly has been in place for quite some time.
Change of government's even more so. What's your take, Martin, on that, and in terms of election campaigns and what we're seeing with an election coming up, more broadly?
I can't really see either side of politics changing their stance. I mean, Bowen's been given a lot of opportunities to change either their imputation credit stance or their negative gearing stance, but they're sort of sticking to it because obviously their polling suggests that's popular amongst the low and middle income earners, which both parties are targeting.
And popular against the younger generation. What they've done is they've actually pitched. It's a generational fight. It's the millennials who don't have,
by making houses more affordable.
Exactly, which is why they wanted to lower the voting age as well.
Yeah, that's right. But I think in terms of what Roger's been talking about with the resi construction cycle, what we're seeing now is the outcome of policy and changes. Exactly. The tightening of credit conditions last year, the outflow of foreign capital or the stopping of inflow of foreign capital, those things have dried up buyers. And sellers are sitting here at 2017 prices, still hoping to get 2017 prices.
Which is why turnovers dropped.
And the buyers are way down here because you can't get money. So it's going to take a long time for that to change.
Just on foreign buyers, 2 years ago, we had $72 billion of approval, FIRB approvals, or Foreign Investment Review Board approvals, for purchases of new and established property in Australia. That has fallen to $12 billion. So it's from $72 billion to $12 billion. And if you look at domestic buying, this last table that we've got, this APRA table, it shows a substantial drop in interest-only loans. So when that pops up, not this one here, the next chart, hopefully it comes up. But what we've seen is back in March 2017, in that quarter, banks were writing about 32 or $34 billion of interest-only mortgages. That is now about $12 billion. So we've gone from 32 to 12 billion. So foreign buyers aren't buying property at the moment for the reasons Martin's alluded to. Domestic buyers aren't buying. They're not investing in property at the moment because they fear property is going to fall. So this picture is not going to change for at least 12 months.
As I said, a lot of these measures are measures that have been put in to engineer a slowdown in the housing space. Has it gone,
job done, tick.
Has it gone too far, Martin?
Yeah, potentially, yeah. So, look, I think they were trying to take the heat out of the market, not destroy the market.
It's hard to engineer
and that's the thing, and everyone thinks of soft landings and things like that. But, you know, Roger and I have been in the industry a long time. It's a cycle. There's no soft landings and all that sort of stuff. The responses are always tightened too far. And obviously APRA and the banks and FIRB and all that sort of stuff and the Chinese government, all these things at the same time have led to this outcome, which I think the Reserve Bank wasn't aiming for a 20% fall in the real estate market.
Well, we'll watch this, how it plays out as well with the election. But Roger Montgomery, appreciate your time on the show.
Always a pleasure.